Today, we're going to talk about the 5 most common mistakes that people make and how they affect their trading.
My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found at some of the largest proprietary trading firms and hedge funds in the United States. Top 5 most common trading mistakes. Mistakes and respondability. One really core element of successful trading is being responsible for everything that happens to you, taking ownership, not being a victim, but taking ownership. Rule number 1 for us is always come back tomorrow. What does come back tomorrow mean? It means that the decisions we make today will never jeopardize our ability to come back and trade tomorrow. We're going to do the things we need to do to protect our account. We're going to make sure that our trades are always in a proper size. This leads to the disclaimer. The results you have are your own. Everything that we show to you in Trader Tip Tuesday is for educational purposes only. It's to expand your mind and to look at things from different perspectives. And through doing this, you're going to be able to grow as a trader and as a person. So let's review the top 5 most common trading mistakes. Mistake number 1, concentrating on the investment or the stock selection rather than the potential reward to risk ratio. This is a big one. People have a belief that Bitcoin's going up or the stock's going up and they need to get long. When we look at trading, we want to reduce trading to a simple math game. No emotions, just a simple math game. The key element in successful trading is having great reward to risk ratios, not win percentage. So people all the time jump into a trade because they think it's going higher. That's not a reason to buy something. You buy something because it has a good probability with an excellent reward to risk ratio. That's all that matters. 2, the need to be right, taking a profit too quickly or not taking a loss. I see both of these all the time. The big one I see is taking a profit too quickly. Disciplined traders cannot stand to see a winner turn to a loser. So they take the profits and that kills them. So one of the things that we're doing is we're establishing an R value for each mistake. So if you buy the stock because you think it's going up, with no consideration for reward to risk, you would subtract 2R every time you do it. This is an arbitrary number. It could be whatever you want. Number 3, not having a risk point before taking a trade. In other words, not knowing where your 1R loss is when you enter into the market. Anytime you jump into a trade with no idea where your risk point is, you're going to subtract 2R. Here's number 4, having too many positions in a portfolio, causing you to not pay enough attention to something critical. Problem is that anytime you have this many positions on, you do not have a good plan for each individual position. And my belief is those positions will bleed you. When you have too many positions in a portfolio, you're guaranteed to make mistakes. If you have too many positions on, subtract 1R. Last one. Refusing to exit your trade at your target because you're now convinced it's going higher. Traders get into this mindset. Their trade takes off and they get euphoric. You're like, yes, this is it. They're at their target and they're like, this thing is going to the moon. And they don't get out and then they watch it collapse. If your plan says to exit at your target, you follow the plan. You don't care about your feelings. How can I prevent these mistakes? We'll look at 3 critical tasks from the task of trading. 1 is self-analysis. Make sure you're mentally ready to go. There's no distractions. You're not sick. You're not in a fight with your spouse. You're mentally locked in. 2, mental rehearsal. Use imagery to rehearse your trades and rehearse your plan. See them working and see them not working and see yourself taking action just as you're supposed to by your rules. And 3 is daily debriefing. Depending on how often you trade, the daily debrief or the weekly debrief is critical to go through and really tear apart what you're doing and analyze your mistakes. You should look through your trading diaries or your journals and your trading logs, and you should keep a record of future mistakes. So we keep track of our efficiency ratio and we keep track of our mistakes. We want to determine what our mistakes cost us in terms of R. Then we'll document each mistake and what it cost. And I encourage you to send it to us at support@tradingmatrix.com and we'll give you an update on our mistakes research. In addition, we have our Red Pill Tribe. Unplug the Red Pill Trader Awakening. This is where you exit the simulation and enter the Red Pill Tribe. Awaken, unplug, begin. The Red Pill Tribe is not a course. It's a trading transformation community in which you'll get access to several high-level courses, a live chat to be able to ask questions, get feedback, share wins. We have a win feed and a market news stream. It tracks key news that moves the markets. We have a Q&A thread where you can post questions and get answers. And we have monthly missions and challenges where you can push yourself through focused trading missions, and you can win prizes and get recognition in the Trading Matrix Hall of Fame. Here's the link to sign up for the Red Pill Tribe. This is the greatest secret in the trading community. Thank you. And you know what day it is. That's right, it's Tuesday, but it's not just any Tuesday, it's Trader Tip Tuesday, where I come to you with tips like today with the 5 most common trading mistakes and what to do about them to help take your trading to an elite level. I'll see you next Tuesday.